you notice your home payment rising this year without any reason you can pinpoint? This is despite having a fixed rate mortgage. We have real estate expert Noel Collier to explain what is going on and how you can try to reduce it or get a handle on it for the long haul. Noel, a lot of people are getting, or some people are getting sticker shock. They're saying my mortgage payment has gone up, and it's not that simple. Many people sign for the 30-year fixed, or if you got the adjustable rate mortgage, that's a different story. But if you have the fixed, it means fixed, right?
Yes and no, right? And so is the way that I'll answer that. And it's such a good, I love that we are talking about this topic, Isaiah, because I have had some people this year, especially since the COVID boom, if you will, that have called me and said, Noel, I thought that you said that my mortgage would not go up. And so actually, it's not their mortgage because they are on a fixed interest rate, right? A lot of the times, these are your FHA loans, your VA loans, your USDA loans, and even your conventional loans are fixed rates. So what they are seeing, Isaiah, is actually their property taxes have gone up. And so what the city of Houston has done, and really nationwide, we've seen this, is they've raised the value of your home, which is what you want, right? So if you purchased that home at $500,000 2 years ago when we were in this COVID market, now your home is valued at about $600,000, give or take, right? So instead of being taxed on $500,000, now your property taxes are based on $600,000. And that's where people are getting confused.
And what would be the negative if your property value went down in value? And how would that affect you long term if you have a depreciating property?
Right. Hopefully, no one has a depreciating property because real estate is one of those investments that we say, hey, it's a safe bet, right? Meaning that they're going to see their equity appreciate on average 5% to 7% on a year over year basis. But what we saw during those COVID years was crazy, right? Almost like 50% in equity, 30, 40, 50% in equity in a 1 to 2 year period. Y'all know the city of Houston's going to capitalize on that. They're not going to let y'all make it. They want their coins too. And so that is, the negative part of that though, is if it does depreciate, which is, we haven't seen that happen. But in certain instances, Isaiah, we can see some property values depreciate. The key to that is staying in the property longer so it catches up, the equity catches up, and don't sell when you're in the negative. Again, rarely happens, but we have seen it happen.
Now, to keep you from being caught off guard when you see an increase in your property taxes, you have to open all those envelopes that come in the mail, right? Because they will alert you that your property value has changed. It goes to the mortgage company. The mortgage company, adds that on with your equity.
Yeah, with your escrow.
Escrow, sorry. And you get it you get the bill.
You do. You get it in the mail, but Isaiah, it can lead to some issues, right? Because some people are at their max budget when they're purchasing these homes. So can you imagine being at your max budget again if you're purchasing a $500,000 home back during the COVID timeframe, your interest rate was below 4%. So that's roughly a payment of $4,000, just roughly, don't shoot me, right? If that's going from $4,000 to $4,500 or $4,700, that's a huge difference on a month-to-month basis. That can cause people to go into foreclosure. They don't have to go into foreclosure. Call me, I can help you. But it does cause people to go into foreclosure.
Now, what would be your advice? I mean, common sense would say don't get your max budget when you're buying a house.
Thank you. Yes, if you're working with a real estate professional or a mortgage professional that is wanting you to max out your pre-approval, they do not care about you. That is not the way to go, especially not in this market. If you're pre-approved for $400,000 and you're working with me, I'm going to say, hey, we're looking at about $300,000. We don't want to max you out, just in case those property taxes do go up, because your property is going to gain equity, right? And so in a master plan community like a Bridgeland or an Ellison or, the Groves over in Humble, those property taxes are going to be a little bit higher because they're master plan communities. versus a pocket community like a DR Horton community or, a Kalina Homes community. Those
Mhm.
property taxes are going to be a little bit less. So we're talking 3.5% taxes to 4% taxes in master plan communities versus 2%, 2.5% in non-master plan communities. Those swings are huge differences in your mortgages.
And that would be good information to have when you're buying a home. Do I want to
That
stay
would
in a
be,
master plan community or the smaller community?
yep, because I'm going to pay a little bit more if I'm looking at a master plan community.
And of course, we'll continue this discussion after the breaks. Welcome back to The Factor Uncensored. Real estate expert Noel Collier joins us to talk about the biggest mistake home buyers make while trying to get around paying those taxes.
There's one other way also, Isaiah, that I just want to touch on really quickly, where a home buyer or a homeowner can see their property taxes increase. And so there are some people that when they purchase brand new homes, so new construction only, this is not for homes that have been previously owned, they can choose to close that home on just dirt, is what we call it, right?
Mhm.
Meaning the dwelling is not included in the property taxes. Only the land value is included in the property taxes. What that does for the homeowner is it allows them to bring less money to the closing table, but they're really setting themselves up for failure, because what's going to happen is next year, those taxes are going to come due. And I've had that happen before with one of my buyers, that they were adamant that they wanted to close on just dirt, and they ended up having to pick up a part-time job so they didn't go into foreclosure.
Wow, you're just kicking the can down the road.
And I'm telling you, it's inevitable. You are going to have to pay those taxes.
And when it comes to, and what about the option of challenging the taxing entity in your area? Getting
Yes.
maybe a professional or yourself saying, look, here are the comps in my area,
Yeah.
and my taxes are higher than everyone else's, or can you do that?
You can contest your property taxes. There are actually law firms that's all that they do is they contest property taxes. Now, I am not an attorney and I don't contest property taxes for my clients, but what I do is I pull the comparables for them. So I pulled a lot of comparables this year, Isaiah, because we sold over 70 homes last year and the year before. So people were kind of freaking out when they saw their tax bills shoot up. So of course, the first thing that they want to do is contest those property taxes.
Got it. Noel Collier, the Collier Group, thank you for joining us here on The Factor Uncensored and educating us today in what we need to do if we get that sticker shock in the mail. Thank you, ma'am.